Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to Financial Fridays with me, Hannah Chapman, and Mr. Brad Haines. We're going to talk about what is happening in the markets, what's gone on the last couple of weeks, and what we expect to see over, soon in the near future. But then also, what are the implications that we are seeing? What reaction are we seeing from the markets right now? And what's the context and what's the subcontext? So that's what we're going to be talking about on these regular Financial Fridays with Brad. So Brad, introduce yourself, remind the listeners who we're talking to, and then we'll dive in.
Thank you, Hannah. Again, I'm Brad Haines. I'm the Chief Investment Officer of Juncture Wealth Strategies and Juncture Asset Management. Been managing money for roughly 30 years. CFA charter holder, financial risk manager. So that's in a nutshell who I am. So
part-time power lifter.
We always have to have our hobbies. So
it's good. I love it. So tell me what's going on right now. And the two things that I think are really prescient in both like the collective consciousness and, investors on the ground, inflation and Fed rates. So let's talk a little bit about those. What do you see and what should we see and what should we be looking for?
Yeah, those are great topics, and they are top of mind of every client, center of influence, any person I run into. Their questions are going to be very quickly inflation followed by the Fed policy. So this is a great topic, very timely, obviously. So today, here as we sit here, or actually yesterday, Thursday, European inflation came out much hotter than expected.
And so we're talking today, it's March 2nd is when we're having this conversation. And so we're talking about the European inflation rates that came out today, Thursday, March 2nd. Okay, keep going.
So European inflation, X energy. So last year, if everybody remembers, prior to the Russian invasion of Ukraine, energy prices spiked. Both oil and gas really spiked dramatically. In fact, everybody was very, very concerned that the Ukrainian citizens, Polish citizens, German citizens, French citizens, UK would not be able to afford energy this winter because energy prices were so high because the supply was constrained, right? Russian oil and natural gas was no longer welcome in Europe. And so everybody was very, very concerned. That has not been the case. So this inflation rate was X. They took energy out, that component out, and it's still the highest in many, many years. So that is a very strong follow-on, but it's also followed on by a little bit stronger inflation readings here in the United States over the past week. So it's kind of dovetailing into, wow, a lot of investors are saying, man, maybe things should stay. Maybe inflation's going to be here a little bit longer than we expected. Maybe through 2023 into 24, what's that going to do to the Fed? How's that going to impact their trajectory? Well, we had a couple of talks from some Fed governor, Governor Waller, and then Atlanta Fed President Raphael Bostic, both of which said the exact same message. Mm-hmm. This message was interpreted very differently by the markets. So going into the speech, the S&P 500, the NASDAQ 100 had all sold off pretty decently, anywhere from down a third of 1% to down 0.5%, somewhere in that range all day. President Bostic starts to speak and says, hey, if inflation is moderating or comes in, less than expected, we're probably just going to go with 25 basis point increases or 1/4%, and then we'll have to see. Well, that's what the market heard. The market then rallied pretty significantly to positive levels and stayed that way for the rest of the day. If they would have listened to the second half of his comments, he also said, if inflation stays where it is today or stronger, then I can see and justify a higher interest rate path for much longer.
Hmm.
Those comments were also reiterated by Governor Waller after President Boston. Now, that it did not sell off the market. The market continued and closed positively. And so that's kind of what I experienced, what I think 2023 is going to be like. It's going to be the tale of two different extremes. You're going to have people that are very much wanting the equity market to go up, because they believe the Fed is going to pause. And then you have another group of people who believe the market is going to decline significantly because interest rates are going to be much higher for much longer, and they're going to eventually, the Fed is going to break some part of the credit or liquidity markets.
So when I sit, we typically have our, investment meetings on Wednesdays where, the advisors get an update on Brad's thoughts for the week. And I'm usually the one, I raise my hand and ask all kinds of questions. Because when I see something like, hey, if inflation is still going up, hey, if the Fed is saying they're still going to raise interest rates, like, why is the market responding the way it's responding? Why is it, either dropping significantly or in today's case, like raising significantly when we're still talking about rate hikes coming in? And so I love how you expand on that and say, yeah, you're right. There is a disconnect, and here's the disconnect, and here's where I think that's gonna, take things later on in the year. So let's keep opening that up a little bit more, because people, I think, need to, people want to know. People want to have at least some understanding of the mechanics between these two forces, inflation and interest rates, right? Because we hear about it enough on MSNBC and, CNN and tickers. And, well, I'm usually just on my phone, right? So Apple scroll, the news that comes out, they'll just talk about, the Fed raised interest rates, or the Fed didn't raise interest rates as much as we thought they would, or inflation came out at this crazy number, right? Without context. So what is the context that you see that we're not necessarily getting in the, headline news that people are absorbing without, having a deeper understanding? Oh, you're on mute. There we go.
One of the contexts that I believe people are missing a little bit is for the past 20 years, the Federal Reserve has maintained a lower than normal interest rate policy, whether it was quantitative easing, quantitative tightening, just lowering interest rates to virtually zero for a very long period of time.
Mm-hmm.
That is a context that a lot of investors, that's what their investor lifetime consists of. They've never been in markets in the 90s and early 2000s when freely floating yield curves and interest rate policy were that way, but they were at normal levels. Okay.
So yeah, let's put that into context too, because when we talk about, what's normal to an investor, we're not just talking about people who are in their 20s right now, right? When you say 20 years of very low interest rate Fed policy, that is, I mean, when we think about when people truly start saving for retirement, start having assets that they're starting to put away, a lot of times that's someone in their late 30s, 40s, 50s even.
Right.
And so we're talking about if you started saving 20 years ago and you were 40, now you're 60, and this is the only interest rate environment you really know. So this is not talking about just, the younger generation who's starting out right now. This is a huge portion of the population representing most of, the people who actually have retirement savings, which would be in that, age at least 35 plus range. This is the entire experience we've had with the stock market personally. And that goes for me too. I'm almost 39. I think I started my first 401k when I was probably 19 because that's just me. But for the most part, right? Like same. So let's talk about that a little bit, because in the 80s and 90s, some people listening might have a little bit of context around this. When we talk about like the savings and loan crisis in the 80s, and we don't have an actual memory of having a mortgage that had a 17% interest rate, but we know that that happened at one point. So walk us through that a little bit. I think that's a really interesting, again, piece of context for what we're experiencing now that we need to kind of be reminded of.
Okay, can I share my screen?
Yeah, let's do it. Here, let me give you permission. So for the people who are going to get to see this on YouTube, this is
Oh,
special.
me. They don't have benefit of the visual. I will walk people through um, verbally what we're looking at. So what we're looking at right now, Hannah, is the federal funds rate, which is quote unquote, when we raise interest rates, we raise the Fed funds rate. That's what the Federal Open Market Committee does. And so you can see that, from 2000, which is right here, okay, this little point right here, all the way to today, we've had a very low interest rate policy.
So on the graph, that is the highest point since 2000 was what? Five,
Yeah,
like
we were
five and a
five
half.
05, 06, 07. And then right now, obviously, we're at 4.5 to 4.75, which the expectation that we'll go over 5 in March in the next meeting, which is this month. Um, so this right here is an abnormal environment. Okay.
Mhm.
So basically from 2000 to 2022, that's an abnormal environment. As you can see, the prior to 2000, you can see the average was somewhere in the 6-7% for the Fed funds rate. So what does that mean? So if you're looking across the economy, it means a mortgage rate of 7 to 8, 9%. It's money market rates of 5, 6, 7%. It's corporate bond rates in that same neighborhood. And you also had PE, price to earnings ratio, on the broader index much lower than today's.
Mm,
And that's where I think people get really caught up, is they're looking at PE ratios and they're so elevated. Well, that world has changed because
mm.
as you have inflation, i.e., higher interest rates in the economy, that's really healthy, but it also will constrain investors to say, okay, what about the stocks today that are going to benefit from higher interest rates, benefit from inflation? Those are typically value type companies that produce cash flow today, not 10 years from now, which is, a little bit the growthy, the yeah, more the growth names, more the innovation names, which did very phenomenal the past 20 years.
Mhm.
Going forward, may not have that kind of wind in their sails as much as some of the value stocks, some of the international, some of the smaller cap companies that we're starting to see lead the industry, lead the market here.
So okay, this is really beautiful. So I want to explain this one more time. So from 2000, the year 2000 till 2022, the the range of rates has been between 5 and down to 0%, or it's the highest. Highest was about 6% in 2000, right? And then dropping down.
If you start in March of 01, the highest was 5%.
Okay, perfect. Yeah. So that 5 down to 0, and then we held at 0 for a long time. A really, really long time. So on this graph, that's what Brad is showing. There's this trough that was really extended where from, this graph goes from 1973 all the way to 23. So 1973 to 2000, we were seeing rates, as high as 20% and not going below that. Like at the lowest point, it was in the 4s, but mostly it was in that 6 to 7% range, like you're saying. So this aspect that you're talking about right now, let's open up the value versus growth, because that's a really interesting point that I would like to noodle on for a minute here too. So a value stock, again, like Brad said, is usually something that pays money now. And the word that you might understand with that is dividend, like a dividend paying stock. So you think about the big companies that, you get your dividend every month. That's a value stock. If you're talking about a growth stock, so like a large cap growth stock, we're not going to give any specific names on the podcast, but that would be a company where they're not paying dividends to their investors. Instead, they're reinvesting in the company over and over and over again, pushing for more and more growth. So on the value side, part of your return comes from the dividend that they pay. And it's usually regular and steady, and you know what your dividend's going to be, and you can kind of plan for it. And the underlying price of the stock should hopefully climb over time too. The growth side, you're not getting that steady dividend, you're not getting that income. Instead, your appreciation comes when the actual price of the stock itself goes up. That's your only increase. So interest rates, the reason we're talking about this right now is because interest rates and inflation heavily affect what is going to outperform, right? And so one of the calculations of, well, should we be more in value? Should we be more in growth? Should we be more in international? Should we be more in small cap versus large cap? All of those different pieces of the equation can really be heavily affected by interest rates and inflation. So talk about that for me a little bit.
So a great example, and I think this is probably the best way to understand this concept of we call it in the business equity duration, and I'm sure everybody will be so excited to hear that. But essentially, what it means is a stock that does really, really well in an inflationary environment are like the oil stocks. Okay, I don't want to say any specific names, but there are a lot of big oil integrated companies that do extremely well when the price of oil goes up, which is inflationary, right? That's a little bit of inflation in our economy. If gas prices go from $3 a barrel or $3 a gallon to $4 a gallon, that's inflation just in that one product. So if you think about that, the oil company that produces the oil, refines the gasoline, that's very impactful for them. They increase their revenues very, very quickly, which falls to the bottom line. So their profits go up a lot. So fast forward to a recession where not many people are driving around as much. They're certainly not taking family vacations. They're not flying. Businesses are not sending people on their business flights nearly as much. Well, the demand for that product, the gasoline and for jet fuel, goes down. So as that demand goes down, the supply is the same. That price declines to reflect that new reality of lower economic activity. Well, that is what we would call a value type company. Their revenues and earnings go up or down with the cyclicality in the economy. So when things are good, their earnings take off like a rocket. They make a lot of money very quickly. Conversely, when the economy slows down or goes into a recession, technology company that's innovative. You know, they have a phenomenal new technology that they want to roll out across the economy. It's supposed to increase labor productivity a lot. Well, it's going to take a while to get to earnings for that company. So any amount of cash flow they have, they're reinvesting right back into the new technology, right back into the company. And then what happens is over a long period of time, you'll start to see earnings come through. A lot of the large cap technology companies that we've had that currently dominate the S&P 500 started out 20, 30 years ago as smaller, innovative companies that have just grown. They've grown to that point where they're producing a tremendous amount of cash flow. But the growth in that cash flow isn't quite as exciting as like an energy stock when oil price goes up. Okay. Mm-hmm. So again, they're very, very different type of companies. Both companies have an important part in your portfolio. You just how much you own relative to each other, depending on the macro environment, is very, very critical.
So the other thing, so let's go back to this kind of global viewpoint that you take, because I think from experience, I know from experience that not every portfolio manager has such a holistic view of, all right, well, yeah, let's talk about energy prices in Europe last year, right? I remember that because you talked about it, but I don't know that I would have any clue that that was an issue that could also be, driving global economic, values if you weren't here talking about it. So looking at a global scale, what are the pieces that you're currently seeing, feeling out, paying attention to, that could affect the US stock market, because we are a global economy, so things that happen outside the world are also affecting our major indices, right? But then also in portfolio building in general, like, when do you start to add back in internationals? When do you start to, consider what areas to invest in?
Those are all great questions. I'm going to redefine that a little bit as what do I see in terms of risks? Okay. Because right now a risk is an opportunity, but it also has some risk associated with it. Okay, so these factors that I'm going to talk about, they both can provide opportunity, but also risk to a portfolio. One of the things I'm looking at right now, which could affect the U.S. stock and bond markets, is the debt limit negotiations. That is generally and historically been a non-event. It's been Congress will just sign off on it because we know the U.S. can't default, because a lot of the world economics and financial markets are based on a risk-free rate, which the U.S. Treasury up until now has been the risk-free rate. That's the proxy for it. So, but this time there's more kind of vitriol around the negotiation or lack of negotiation for the debt limit to be raised. Mm-hmm. Now, I think what could happen is there's going to be very little issuance of U.S. Treasuries up until that time. And that is going to be a problem. Treasury Secretary Yellen has to kind of rob Peter to pay Paul during this time where we've hit the debt limit. We still need to pay our bills, So she has to do some financial finagling until the time that we get that debt limit passed. Okay. And supposedly June, July is what I've heard is the time frame for that to actually get passed. Now, what's going to happen when it gets passed is you're going to have a rush of supply in U.S. Treasuries coming on the market. Right now, if you look at the yield curve, it's very inverted. There's it goes up for a little bit for a year, and then it starts to drop off pretty significantly towards the later the further out maturities. One reason for that hump in the beginning is higher interest rates. But people have said, well, why aren't the longer term yields increasing to reflect a higher inflation rate? Because
Right.
that is what generally impacts that further out curve. One of the things is the demand and supply dynamic of the longer term bond. We've had a lot of purchases from the Federal Reserve in that area. They have stopped. Obviously, they're letting some of that stuff mature off now. And so they're shrinking their balance sheet so that marginal investor is not there anymore, or is not the Fed anymore. It's now going to be financial investors and other central banks. But we believe that there is going to be kind of an increase in supply in the further out the curve for treasuries, which may have a corresponding increase in yield in those further out as we get to the middle part to the third quarter. So end of second quarter, early third quarter, you could see the yield curve shift up in a pretty meaningful way. Now, what does that mean to the stock market?
There you
It
go.
means that the stock market is probably not going to establish a great trading pattern or it's not going to establish a new bull market during that time. There's one, too much uncertainty. Two, the Fed hasn't paused yet. But once we get to the point where that increase in supply of Treasury securities has come out, and the Fed has started to see that we're entering a recession or a big slowdown to like zero on GDP growth, they might come out and say, okay, now we're going to pause. And once we pause, once the Fed pushes that pause button and the Treasury securities are assimilated into the market, that's when I believe you're going to start to see equities start to make a foundation upon which they could rally towards their highs, or start to make their way back towards their highs. I don't think there's very high probability they're going to make their highs in 23 or 24, but they'll start to put that pattern into place.
Interesting. So it has more to do with that feeling of, it's so funny because I talk about this on like literally a personal level too. Like, so it's funny that it holds true in the macro, that feeling of stability, that feeling of, okay, things feel safe and slightly more predictable is what then allows for more growth.
Absolutely. If you're a CEO of a large company, or you have a household you're running, the same behavioral or psychological concepts apply, right? So if you're looking at if you're sitting at home and you're in a household, you're listening to this podcast or watching this podcast, you are the CEO of your home. Okay. So if I was going to tell you, hey, interest rates are climbing a lot over the next year, how is that going to impact your economic behavior? You know, if you have some floating debt, i.e. credit cards or installment loans, are you going to try to fix that, or are you going to try to pay it off? Those same decisions that you make for your household apply to the CEO who's running a multi-billion-dollar company, because that uncertainty for him or her is hey, do I get to keep my job next year or not? You know, they really don't like to take risks where they're not pretty sure that things are going to work out. And so whether the CEO of your household or the CEO of a company, that the same psychological phenomenon applies.
Mm. So interesting. It's so interesting. Is there is there any other little piece from, from this week and going into next week that seems relevant that you're going to be watching for over the next little bit here?
Yeah. Labor productivity. So the only ways you can get economic growth, if we, for whoever has taken economics 101, here we go. Or for those of you who haven't and really never wanted to, I apologize.
Here we go. You're going to learn something.
Yeah, the three ways you can do it. You have labor, you have resources, i.e., natural resources, and you have technology. And the reason technology is important is because technology can help land or natural resources and labor produce more goods with the same amount of inputs. All right. So it allows us to get more for less, which is why we had, the United States, actually the world, but the United States specifically, had such a huge productivity boom over the last 20 years. Why? Well, because of the internet. I mean, if we just look at 2020, going into a complete shutdown, and within 2 weeks, for the most part, many companies converted from you have to be in your seat in the office to you're at home in your office working. So that evolution, that revolution in terms of how we function is a huge productivity gain. I mean, I know for me, I was able to work more or less the same without the commute. So even if I just my commute, which is an hour and a half a day, okay, if I get rid of that and I take part of that time and I actually work, which I did, I'm getting more done for less. Okay.
Yeah.
So that's an important. So I'm watching labor productivity, which has been very stagnant for the past couple of years. So it's something that we had this huge boom in 2020, 21, 22. It did not continue. And my guess is with AI, machine learning, and the like, that we're setting up for a new boom in productivity, which will eventually bring down, a lot of. It'll make things a lot more efficient and effective across the economy. Additionally, I'm looking for, which may or may not happen, but transferring of supply chains out of China and out of strategic adversaries to the United States and Europe, transferring those supply chains to other nations or to ourselves. So, we used to call it offshoring when a manufacturer would take their jobs to China. And now it's being called onshoring or friendshoring. So we don't necessarily have to move it to the US, but we can move it to Australia. Okay. So if Australia is there, or to Japan or to South Korea, those are some places that could be beneficiary. So that trend of onshoring, friendshoring, however you want to describe it, is something that I'm watching significantly, because it's gonna take a massive amount of money to do it without a tremendous amount of benefit from an efficiency standpoint, but a much better resiliency profile. So you can count on getting your products when you order them, as opposed to, China, which shuts down their entire manufacturing center because of COVID, or because they don't like you, whatever. I mean, they can do it for any number of reasons. So getting a little more resilient, it won't be well, it may be as efficient, but it's going to cost a lot of money for the same efficiency. So it could be a little bit of a drag on the global economy in that sense. So I'm watching that trend as well.
Interesting. Well, I think we will wrap it up for this week. And as we said last time, like, if any of this like sparked a question, or you want to hear anything different, or you have a question that you want Brad to address, and then you want me to translate into normal human speak, send them over, so we can help you learn and get to know the financial markets on a more intimate level. So anyway, thank you for being here with me again, Brad. I appreciate you, and I appreciate all that you do for me and for my clients. And I love getting to put you on this podcast and let you talk to more people.
Well, I appreciate the invitation, and I will be here anytime. Please do write in your questions. I'm always watching a ton of things, so but if you have a specific question that we can address, I would love to do a little more research to figure that out for you. So please do write us in the comments or in an email. We would love to do that.
Awesome. Thanks, Brad.
All right, have a good one.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.